Hello, this video will cover the LIFO cost flow assumption under a perpetual system. Again, LIFO stands for last in, first out. However, I like to tell my students last in, first sold. So the items that came in last are going to be the items that we sell first, and then the first items will remain in our ending inventory. Now, in my family, we don't drink a lot of milk, so milk tends to go bad before we even finish it. So one of the things that we do when we go to the grocery store, I don't know if any of you out there do this, but I get on my tippy toes and I go to the milk section and I grab a carton way in the back. And the reason why I do that is because the store is trying to get me to purchase the ones that came in first, but I want to have that dairy product or that milk last as long as it possibly can. So what I'll do is I'll get the one in the back because those are the items that come in last. So I call this approach the lactose approach. If you ever look at the date, you'll see that the last items they're trying to get you to put them to pick those last, but I try to outsmart them. So with the LIFO method, it's the last ones that you're going to use for your cost of goods sold. And then that means that if you're going to use the last ones, then you're going to have the first ones are going to remain in your ending inventory. So it's going to be the flip version of the FIFO method. Let's see. So what we'll do here is, again, we're selling 25 items on the 31st. This is clearly after January 30th. So on this date, we're going to assume that those that came in last, so that'll be January 30th, we'll use that to cost out our, a little bit bigger, cost out the 25, and on the price we paid on the last date was $12. So we had 15 units at 12. And again, we can't do the full 25 because we only have 15 in this purchase. And then the next last date will be January 10th. And we're talking about what? If we have 15 on the 30th, and we need how many more? We need 10 more to get to 25. So 10 plus 15 is 25. So 15 plus 10, 25. And the January 10th date purchase price was 11. And again, these are exactly the same. The only difference is the price changed. So when we go ahead and do our multiplication, 10 times 11, we get 110 added to the 180. The 290 will represent our cost of goods sold under the LIFO method. And then for our ending inventory, again, if we take the number of units we have available for sale, which is 65, and we subtract the units that we sold, that should give us what we have in our ending inventory. So our units on hand is 40. So because we're using the assumption of last in, first sold, the first will remain. So we'll do the January, so it's the first one, January 1st date. So that's the first date in our ending inventory. We have 20 units that we're going to account for at the $10 price. And then we're going to do the next first date, which will be January 10th. And because we have 20, we're trying to figure out the cost of 40 of them. We're talking about 20 more. And that price will be $11. We do our math, 290 and 420. And this will represent our ending inventory debit to merchandise inventory. So this will be our balance. And if you take the 290 and the 420 and add them together, it agrees to our cost of goods available for sale. And just a side note, if you look at the January 10th that are in our ending inventory, you see we have 20 items, and then the 10 items that were sold from our January 10th. So 10 plus 20, that equals the 30. So we've accounted for all 65 units. And your answer for cost of goods sold would be 290. Your answer for ending inventory under the LIFO method would be 420. Any questions? Ask in the discussion. And remember, today is a great day to learn accounting.